All right, let's talk Sallie Mae. They just dropped their Q4 earnings report, and honestly, it's a fascinating one. On the surface, you see this massive beat, but once you start digging in, you find this huge strategic pivot that really has Wall Street talking and pretty divided. So let's break down what's really going on with SLM. So, the headline number? A big one. Sallie Mae posted GAAP earnings per share of $1.12. Now, you have to understand, the consensus estimate was sitting around 95 cents. So yeah, this wasn't just a beat, it was a significant beat, a really strong way to close out the year on the bottom line. And what did the market think? Well, the initial reaction was immediate and, very positive. The stock closed at 26.70, and then boom, it shot up 7.5% in after-hours trading. That's a really powerful first impression, and it was all thanks to those strong results. Now let's look at what was fueling that pop, because this is where it gets interesting. Net interest income, up 4% year over year. Loan originations, also up 4%. But the real kicker here was the capital return story. Management came out and announced a new $500 million buyback. And get this, that's on top of a program that has already retired an incredible 55% of the company's shares since just 2020. That is just massive. Okay, so here's our game plan. We're going to cover that headline beat we just saw, then we'll dive into what I'm calling the guidance paradox. After that, we'll lay out management's long game, and we'll wrap it all up with our thesis in the next call segment. But here's the thing, that initial positive reaction kind of hides the main conflict in this whole report, the guidance paradox. And this is where the simple bull case gets a whole lot more complicated. This is the one question every single investor was asking after the call. It's simple, right? If the company just printed this huge beat, why on earth did they guide down for the next year? It just doesn't seem to add up, but believe me, it's the key to understanding this entire story. And this slide right here perfectly illustrates that disconnect. I mean, look on the left, a fantastic end to 2025 with $3.46 in full-year earnings per share. But then you look to the right, and the 2026 guidance is for just $270 to $280, and it's being driven by this huge jump in non-interest expenses. So what is going on here? Well, the answer really lies in management's long-term strategy. What they're doing is intentionally taking a short-term hit to earnings, to the bottom line, so they can invest in this massive, policy-driven market opportunity that could literally reshape the entire company. And here it is. This is the prize they're playing for. Management said that recent federal reforms to the Grad PLUS loan program, that's a federal loan program for grad students, could unlock an estimated $5 billion in annual originations. Let that sink in. That's a potential 70% increase over 2025's levels. We're not just talking about growth here. This is a total game changer for their market size. So management's plan basically comes down to two things. First, they're spending big in 2026. All that extra expense is going into marketing and product development so they can go out and win this new business. And second, they're de-risking their own balance sheet. How? They're going to partner up with private credit funds who will actually take on 30 to 40% of the new loans. So, in simple terms, they sell off a big chunk of the new loans, which gets the risk off their books and frees up capital for even more growth. It's a pretty smart move. Of course, none of this really matters if the credit picture falls apart. And what we see here is, well, stability. Yeah, delinquencies and net charge-offs did tick up a little bit from last year. But, and this is important, management's own full-year guidance for charge-offs basically implies they see these numbers holding steady, even with a kind of uncertain economy for recent grads. So, things look stable. Okay, so let's put it all together. It's time to transition to the next call, where we're going to lay out our complete thesis, our rating, and what we expect to see from here on out. Our thesis here is pretty simple. This is a classic short-term pain for long-term gain story. The key takeaway is that this Plus reform catalyst is so huge, it more than outweighs the earnings dip we're going to see from this investment year in 2026. So we're rating the stock outperform. For the next quarter, we expect the results to be pretty much in line, but honestly, the numbers won't even matter. All eyes are going to be on what management says about that Plus volume ramp up. This all sets up for some near-term choppy price action while the market digests the lower guidance, but we think it'll be followed by a re-rating higher once the company starts to prove it can actually execute on this massive opportunity. And that brings us to our final segment. This is where we pitch an outrageous but plausible trade idea based on everything we've just talked about. So the trade idea that really flows from our thesis is this. You buy the stock to capture that huge long-term upside from the Plus opportunity, but because we expect some of that short-term volatility and chop, you could pair that by selling call options against your shares. It's a strategy that basically aims to generate a little extra income while you wait for the rest of the market to catch on to the long-term story management is building.
So that's our take on Sallie Mae's Q4 reset. Look, the company is taking a big swing here. And the real question for you as an investor is whether this short-term pain is going to be worth that long-term gain. As always, make sure you do your own research. This is not financial advice.